Welcome. This is Mike Hood, President of Hood Financial, and thank you for watching. During the next 15 minutes, I will share with you just one of several strategies I specialize in that could help you to diffuse one of the biggest ticking tax time bombs in your estate. Why should you care? Because this strategy could turn forever taxed assets into mostly never taxed assets. Typically, people over age 60 with large retirement accounts and their heirs stand to lose the most because of a new tax law. Were you aware of a change in the tax code that now makes it more difficult for you to pass IRAs and 401ks to non-spouse beneficiaries? This new law, called the Secure Act, or more appropriately, the Not So Secure Act, signals the death of the Stretch IRA as we know it. The good news is I am uniquely qualified to help you diffuse this ticking tax time bomb by using a safe and legal yet little known strategy I like to call the Super Stretch IRA, or you could think of it as a Roth conversion at death. Now, don't go looking these up. The reason you've not heard of this before is because I've made up these names. This strategy has all the tax advantages and benefits of a Roth IRA, but without you having to pay a ton of extra taxes during your lifetime, as with a Roth conversion. After watching this presentation, you'll see why I should be your first choice for a second opinion on this unique area of your estate planning. We'll begin in just a minute, but first, the all-important disclaimer. You know, for the lawyers. Now that we have that out of the way, for over 30 years, I've helped many people just like you protect all your hard-earned assets well beyond any other planning you may have done. My services focus on three major areas: financial planning, investment management, and asset protection. Today, we're talking mostly about asset protection, and some people think living trusts when they hear asset protection, and yes, they can be part of the equation. But I go well beyond living trust planning and look for all the ways your assets and income may be vulnerable to loss, and then help you to protect them. The so-called Secure Act, which stands for Setting Every Community Up for Retirement Enhancement, was passed in December of 2019 and is a complete game changer in the world of estate and tax planning. It affects all of you who want to leave IRAs, 401ks, or any other type of qualified retirement plans for that matter, to non-spouse beneficiaries. Now, fortunately, the rules for spouse beneficiaries remains the same, but don't forget, they will still have to pay taxes as well, forever. This new tax law is very complex and with many different rules and caveats, but still includes some of the heftiest penalties the IRS dishes out, up to 50%. Here's a little background. In 2014, the Supreme Court ruled that IRAs inherited by non-spouse beneficiaries, typically your kids, may no longer be protected from creditors. In response to this, many estate planning attorneys adopted the use of so-called IRA trusts. These trusts offered creditor protection for an inherited IRA. But even if you protect the inherited IRA from creditors, a potentially rare situation, there still remains the issue of income taxes to the beneficiary, which is 100% certainty. Because of the Secure Act, many of these IRA trusts may now need to be redrafted for these new provisions. But remember, while the IRA trust still creates creditor protections, it will never eliminate income taxes from your IRA as it passes to your spouse or non-spouse beneficiaries. Speaking of taxes, just take a look at the tax rates for trusts. It begs the question, does it still make sense to leave your IRA to a trust anymore? If that's your current plan, you and I really need to talk. Here's what this new law means in a nutshell. Prior to the Secure Act, non-spouse beneficiaries could stretch payments from inherited IRAs over their remaining life expectancy, which, depending on the age of your beneficiary, maybe a child or grandchild, could have been for decades. Now with the Secure Act, non-spouse beneficiaries must withdraw the entire balance of an inherited IRA by the end of the 10th year after the year of the IRA owner's death. Ouch! You don't need to be a tax expert or have a degree in accounting to understand that this is a significant and very costly change. There are, however, a number of solutions you could consider in response to this, such as Roth IRA conversions, where you pay a lot of tax now so you and your beneficiaries don't have to pay later. There's so-called asset splitting, where you could leave taxable assets to lower tax bracket beneficiaries and non-taxable assets to higher tax bracket beneficiaries. There's charitable gifting plans, which are often overlooked and could be a good option if appropriate. Life insurance. While it's very much misunderstood, this remains one of the best kept secrets in the tax code. And finally, the solution we'll look at today, the Super Stretch IRA or Roth conversion at death. that allows you to turn forever taxed assets into mostly never taxed assets. As you can imagine, there are as many variations on this concept as there are client circumstances, and this is definitely not a one-size-fits-all solution, and we don't recommend you try this on your own without professional supervision. So let's take a look at a sample case study to see how these new rules play out in the real world. The names, details, and circumstances here are all fictitious, and as usual, past or future performance is not guaranteed. Values could be higher or lower, and your mileage may vary. So let's meet Mary, a 75-year-old widow with a daughter, Susan, divorced age 50, and a granddaughter, Lisa, single age 25. Like most people, Mary would like to pass as much of her entire estate as she can to Susan and Lisa and minimize taxes as much as possible. She would also like to maintain control both during her life and after she's gone, especially because she's a little concerned about leaving a lump sum to Susan. She also wants to simplify her estate distribution and avoid a lot of administrative fees, headaches, and hassles. Now, with the passing of the Secure Act, Mary is starting to understand that her current plan, which she thought would protect her estate and heirs, has been essentially legislated out of existence overnight. Here are some of Mary's challenges if she leaves her present plan as is. The first obstacle is her rather sizable IRA and the fact that it gets smaller and smaller every year because of required minimum distributions. Her IRA balance will most likely never be as large as it is today. And with volatile markets as well, Mary has little certainty as to how much Susan will even receive upon her death. When Susan does inherit Mary's IRA, she is required to take more over a shorter period of time, most likely when she's in her peak earning years. Wow, talk about the perfect storm. Susan also faces stiff IRS penalties of up to 50% if she deviates at all from the Inherited IRA rules. If that wasn't enough, Susan will pay additional trust and trustee fees and investment management fees, reducing the Inherited IRA's value to her substantially. Lastly, again, she must empty the entire Inherited IRA balance over a 10-year period. So think about it. Is this really the best plan there is? Is there a simpler approach that would give Mary all she's looking for with more certainty, less risk, less fees, and complications? Let's now take a look at just one alternative she could consider. For the sake of simplicity in this presentation, I'm purposely leaving out some details. We first remove Mary's entire IRA account, but not the IRA income, from her estate for estate tax purposes. This is a non-taxable transfer, and Mary will continue to receive IRA income, but at an increased amount. She will also pay a little more in income taxes over the remainder of her life, which she's okay with. This first step eliminates any income or estate taxes on Mary's IRA at her death. Because of her concern about leaving Susan a large lump sum, Mary has chosen for Susan to receive guaranteed payments for 20 years. Each of these payments are 87% non-taxable and non-reportable, saving Susan a substantial amount of income taxes each year. Mary could have chosen several other options for Susan, including a shorter or longer payout, including lifetime. Or she could have simply left a tax-free lump sum, as opposed to the forever taxable IRA. Mary had complete control over these choices at the time of plan design. Further, if Susan passes away before the 20 years is up, Lisa automatically receives those same payments guaranteed. The entire plan, Mary's lifetime income, the amount Susan receives, the manner of payments, etc., are all guaranteed and require no maintenance or investment management of any kind, and is fully administered without the need for a trust or trustee, and avoids all of those fees as well as any investment management fees. Simply put, it's a lot easier, less costly, more secure, and best of all, it's on autopilot. Finally, the entire plan and all I've described is unaffected by any negative market performance. Now that you have some background on this strategy, let's take a look at this sample case study using actual numbers. We're going to compare what the rules and results look like between three plans, starting with door number 1, the Stretch IRA as before, door number 2, with the Secure Act, now that the Stretch IRA is dead, and door number 3, using the Super Stretch IRA Roth conversion at death strategy. We're making the following assumptions. Mary's IRA balance is $1 million at her age 75 and earns a 4% net return, and she's in a 30% bracket. Susan will invest more aggressively, earning a 6% return in a 40% bracket. So, door number 1. Mary passes away at, say, age 90. Her total income from age 75 to 90 is $900,000. At 90, her IRA balance is now estimated at $700,000, and that's what Susan receives. But she now has up to 20 years to spread out payments totaling $1.3 million by her age 85. At that time, the IRA is depleted and the income stops. After paying $500,000 in taxes, her net income is $800,000. Again, that's how things used to be, and that plan, ladies and gentlemen, is gone forever. Now, door number 2 and the new reality. With the passing of the Secure Act, everything in the previous example is the same, except that Susan now only has 10 years to empty the IRA account. There are a lot of variables in withdrawal timing since there are technically no actual required minimum distributions each year as before. But in this example, we've assumed that Susan takes annual withdrawals as if they were a required distribution to spread out payments over 10 years. You can see right away her total income is a lot less what you would expect. Her taxes are $350,000 and net income is $550,000. That's a 30% reduction from what she would have received prior to the Secure Act. Now just let that sink in for a minute. This is what Congress was up to the week before Christmas in 2019. And finally, door number 3. Mary pays a little bit more taxes and has slightly less income over her lifetime. However, at her passing, Susan, just as if she had inherited a Roth IRA, now has a guaranteed tax-free benefit of $750,000, which is paid out over 20 years, resulting in Susan's total income of $860,000, with very little tax to pay of $45,000 and a net income of $815,000. This is a perfect example of the phrase, it's not what you make, it's what you keep. With this plan, Mary has succeeded in passing more than the after-tax value of her original $1 million IRA, and then some, all without the uncertainty, fees, and administrative hassles found in commonly recommended strategies. She basically did a Roth conversion in a 10% tax bracket. In conclusion, your IRA can only go 3 places: your spouse and kids, charity, or the IRS. It's your choice. But just know this, without any additional planning, your default plan includes Uncle Sam as one of your biggest heirs. Is that what you had in mind when you did your living trust to begin with? Is that the kind of legacy you want to leave behind? Again, from a tax perspective, an IRA or any kind of retirement account is one of the worst assets you can leave behind to a spouse or heirs for 3 reasons. It's taxable forever, there can be several restrictions in accessing the funds, and huge penalties for getting it wrong. Now is the time to get a second opinion on this important part of your estate planning. I know that the work you and I can do together will make all the difference in the world for both you and your heirs. The Super Stretch IRA or Roth conversion at death strategy is just one of many solutions we will explore together. So you might be asking yourself, is this strategy right for you? It might be. But it's not for everyone, and there are a few eligibility requirements you'd have to meet first, so we should look into this right away. If you like what you've seen and heard today, take the first step towards gaining more control, reducing taxes and fees, and providing better results for you and your family by scheduling a Get Acquainted phone call with me so I can learn more about your particular situation and determine whether the Super Stretch IRA Roth conversion at death is right for you. Please click on my calendar link in the video description below to schedule your complimentary 15-minute Get Acquainted phone call. There is no cost or obligation of any kind, and I really do look forward to speaking with you. Hey, I've appreciated having you with me today, and thanks again for watching. This is Mike Hood of Hood Financial reminding you, Congress has effectively lit the fuse of your tax time bomb. Can you still hear it ticking? Let's talk soon so we can diffuse this thing together before it's too late.